Good evening. It's June 16, Thursday, 5:40 p.m. Welcome to episode 47, Market Selloff. Good evening to you, Wawi.
Hey Mark, what's up?
Good evening to you, Wawi. Can you hear me?
Yeah, I'm doing good. Can you hear me?
Yeah, I can hear you now. I think it's just the COVID in the air. hopefully,
Yeah,
hopefully,
still floating.
yeah, hopefully I'll recover from it quickly. Well, good evening to you guys. For those who are tuning in, this is episode 47. This is your host, Mark Yu,
Wally Santos.
and welcome to the Mark Yu and Wawi Show. A disclosure: this show is made for sharing information purposes only, not to be considered investment advice. I and Wawi are both physical therapists here in USA with a passion and interest in researching and investing our hard-earned money in the stock market. So for those who have missed our episode 46, we looked at the S&P 500 forward earnings valuations, credit card expenditures, and inventories to sales ratios, which are slowly climbing. And on this episode 47, we're gonna look at obviously the ongoing sell-off in the stock market. So we're sharing our screen. We're gonna look at our weekly sentiments guide. So first off is the American Association of Individual Investors. They usually take this survey among those active in investing to see their outlook if the stock market will go up or down in the coming next 6 months. And they came out with an update yesterday. We're back down to less than 20% again. We're in the teens. We're at 19.4% for those who are thinking that the market will be up, or for those who are bullish, down from 21% last week, while bearish sentiments have climbed from 46.9 last week. We're at 58%. What do you think, Maui? Does this reflect the overall market sentiment as of today?
Definitely not reflecting the market today. It's a sea of red today.
Yes. Well, yeah, people are getting more bearish for sure. Hopefully, some of you guys are still invested in the market for the long term and not perturbed. Although it's really hard to look at your portfolio every single day. Well, yesterday was kind of like a correction where, not a correction, but an uptrend yesterday, an uptick, not an uptrend, an uptick yesterday right off the bat when the Federal Reserve decided to surprise the market with a 75 basis point hike compared to what was expected as a 50 basis point hike. They changed their mind and they hike up by 75 basis points. What do you think about that, Huawei? They just increased it by another 25 basis points to 75 in total, the highest in the last 20 plus years since 1994.
Yeah. So the Fed did what most, most analysts are asking.
Uh,
So they did their 75 uh, point rate hike.
right.
And then we have a sudden massive correction today, which is just like an insurance.
Yeah.
An insurance to what uh what 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 happened yesterday.
Right. So within the past few months or past few weeks, people are already expecting that the Federal Reserve would hike 50 basis points, and that'll be it. But come to find out, they went in for the shock, and the stock market kind of reacted positively, actually, coming off of the announcement. But come after hours yesterday evening, futures started selling off, and then this morning further sell off, and then until now, everything else went downhill, as we're gonna see in a little bit. Not one sector has been spared for the past 5 days. Definitely for the past 24 hours, everything just sold off. The fear and greed index we're looking at, it's at extreme fear. We're back at 14 points, whereas last week we were just hovering around 31 points. So definitely fear in the market, extreme fear. The market momentum, which compares the S&P 500 movement compared to the 125-day moving average, is down. It's definitely in the extreme fear territory as well as of right now. The stock price breadth, so this is the McClellan volume summation index. So we didn't quite define this in our previous recordings, but this is quite what indicates the liquidity in the stock market. If the liquidity is high, it's the trading is favorable and it's much more bullish, or people are excited to trade. But at this point in time, we haven't seen this low for the past 12 months. So people are afraid of buying or even selling their shares at the moment. We are definitely deep down in a negative territory, indicating that people are in extreme fear. Put and call options, obviously, we're at the highest within the past 12 months. People are buying insurances against their portfolio. Put meaning people are betting that the people are buying insurance in case the stock market drops. Call meaning people are buying bets that the stock market will go up. For the volatility, we're up 20% in the past 5 days. Definitely, we could feel it in our portfolios, in our pockets. Definitely quite a deep correction right now. Even we're actually in a bear market already, right? Well, yeah.
Well, we have to wait for another GDP drop, then we can call it a recession, right?
Yes. Well, NBR, National Bureau of Economic Research, identifies a recession, I think, at least two consecutive quarters of a drop in economic growth. So last quarter, on the first quarter of this year, we dropped by 1.5%. And I saw a report yesterday from Atlanta Federal Reserve. They came out with a survey that they think that there will be no growth this second quarter at all. Contrary to that, Jerome Powell said that he doesn't see any slowdown in uh, consumer activity,
Spending. Mhm.
which is quite interesting. Probably he's looking at the credit card growth, or credit card debt growth, which is still growing now. People have lower savings rate. People are using credit cards to fund their expenses, daily expenses. For the Nasdaq volatility, which is heavy on the tech sector, which is the most heavily punished sector since the start of the year, volatility in that group is up 12% for the past 5 days. And here we go. 1 week performance of all sectors.
Already.
Every sector is down negative 4% at the least. Consumer defensive. Even Morgan Stanley's pick during this down times, healthcare, it's down 6.4% for the week. Real estate, which usually should benefit in high inflation, or not benefit in high inflation, but uh, maybe a steadfast industry during rising rates, it's down 8%. And surprisingly, for the past week, oil, energy is the worst performer. It's down 12.7%. So even the best performing industry so far this year is now turning the dime, and now it's the worst performing sector in the past week. So this is troubling. So for those that are really diversified, who have energy, tech, and the rest in their portfolio, you're no longer seeing much of green compared to previous months where you always have energy. Like yours truly, I have Exxon and Chevron in my portfolio, and they've slowly climbed up as the top 1 and 3 in my portfolio until this week. They've been selling off. Interestingly, um, so since the start of the year, it's still energy. This is a half year performance. Energy 28.9% positive, and the rest, all other sectors, are down in the deep red territory. Communication services is down 30%, consumer cyclical 33, technology 33.84. So if you have technology in your portfolio, like yours truly and Huawei, everything is definitely in the deep red territory. It's so ugly in my portfolio right now, having those tech exposure. Like I have Netflix is down 40%. Facebook, I think down more than 40% or even 50%. Facebook of all companies. Amazon also. I think Amazon is down. Let's see how bad it is for Amazon, despite the split. Whereas long time ago, if you announce a split, you're like a winner in a lottery. If you have that stock, you would be gaining like double, triple your value. But this year is
If
an
that was last year, if they split last year, that would have been good.
yeah. Back last year, it was trading around more than $3,000 before the split, and now before they split, they were around $2,100. So since the start of the year, if you have Amazon in your portfolio, you're down nearly 40% as well. So it's been very bad if you have these big tech companies in your portfolio, even though that they're cash rich in position. Um, the Federal Reserve, when the Federal Reserve decided to start hiking the rates back in March, we actually anticipated for a long time. But still, this is like very severe sell-off that we're facing right now. Not everyone is spared at this point in time. But correct me if I'm wrong. I think Huawei at one point last month, one of the Wall Street greats, Michael Burry of The Big Short, actually shorted Apple mid last month. And I think right now, if he's still holding it, he'll be like at least having a fruitful investment shorting Apple. No one would have
Mhm.
thought that shorting Apple would be a great idea, except for you know who, the Big Short guy, Michael Burry.
Michael Berry.
Yeah.
Hmm.
But right while we last year when we started our podcast, it's been about a year and a few weeks now since we started our podcast. Uh, 3 or 4 episodes back, um, I think we started quoting Wall Street legends, Leon Cooperman, Michael Burry of all people,
Hmm.
uh,
Peter Lynch.
Peter Lynch, yeah, Robert Kiyosaki, even predicting that there's going to be a scary sell-off that's going to happen, and that was May or June last year. That was just even before the stock market went crazy and went all-time highs day after day until the end of the year. So all of their warnings back then, if you sold off all your portfolio, you wouldn't have gained what you've gained for the rest of the year last year. And then now we're actually experiencing a terrible sell off. They might have come in a year early, um, in just to realize at this point in time. So I think it may have paid well to heed their warnings. But at this point in time, if you're in the market and you're experiencing a, you know, severe underperformance, you're not alone. So people are definitely experiencing this um, sell-off heavily, right? Wowie?
Yeah, so I'm tech heavy too. So I hold Tesla. So Tesla is down 8.5%. Um, VU, which is the S&P 500 index, is down 3.29%, just like the market is
Just today?
today.
Uh-huh.
And let's see. Yeah, like I said, the only thing green on my screen is Procter and Gamble, CRISPR Therapeutics, and Walmart,
Oh,
which is an outlier for this kind of day.
right.
Uh,
Yeah,
but it's an up and down. It's an up and down market.
hmm. Yeah, it's been tough to hang on, but every day I check my portfolio, it feels like it's never ending. But yeah,
Well,
so
the steeper the drop, usually, the higher the recovery. So
mhm,
you just have to be patient.
right,
We just don't know how long this downtrend is going to be because there are different forces at
true,
play. The supply issue is still ongoing. We're just now starting to unload our inventories in the retail market. We're just now building the houses. It's just now that housing prices might slightly go down, according to some analysts. So, something to look forward to. Uh, Maybe the the rate hike by the Fed might give us some stability,
Right.
but right now they're just pricing it in.
True.
The market is pricing it in.
And as we're looking at the next chart, here's the market performance of the three major indices. Dow Jones for the past 5 days, it's just for the past 5 days alone, it's down 7.27%. S&P 500 is down 8.74%, and Nasdaq is down 9.31% just in the past 5 days, like another correction territory for the whole index. So nothing is being spared right now. The generals, as we call it, the big tech is being shut down. They're being sold off. And now we're down 31.82% for NASDAQ index, the big tech.
Mhm.
S&P 500, it's in the bear territory, which it just dove in a couple of days ago. Dow Jones is down 17.64% since the start of the year. So where is the money flowing? According to this Bank of America survey, ETF flows is most positive in healthcare for the current week, followed by energy. So people still putting their money in the ETF, energy, followed by financials, consumer services, and those are the only uh, industries that are receiving some flow right now. Everything else are being sold off, including real estate, materials, utilities. So by client sector and size, Bank of America sees energy, healthcare, materials receiving some flows as well. This is by client net buys, not by ETF. Earlier it was the ETF. So US dollars performance today actually dropped by 1.29%. So all this time since the start of the year, the dollar has been climbing. A little bit of a weakening.
This is a good sign. So
Mhm.
this is a good indicator.
So the thing about this is I've been looking up some reports. The main reason why it dropped today is because the Bankos Swiss National Bank (SNB) decided to surprise the market and hike their rates as well. So they have their own version of Federal Reserve over there in Swiss. And instead of going with the flow, they haven't done any hiking actually since 2008. They hiked for the first time, not by 25 basis points, but 50 basis points. So the Swiss right now, they're also trying to tackle the inflation through hiking rates. So that's quite an issue, according to some experts. They say now we're rushing to counteract the massive global inflation that everybody's suffering right now. Even the United Kingdom came out with a report, I think,
Yes.
that they're hiking rates as well. And tonight, Bank of Japan is pending any news release if they're gonna hike rates too. So everything else is hiking. I think China is still trying to provide easing their rates, but everywhere else in first world countries, the leading financial um, departments, financial hubs of the world now are rapidly tightening.
Mhm. Well, the decrease in dollar value should allow importers of U.S. goods to avail of our products here in the United States.
Right.
So I take that as a good signal, especially since we have a high trade deficit.
Mm. That could be part of it, but we'll see how it goes. Hopefully, employment still remains strong. I saw the jobs report yesterday, so jobless claims are strong, right, Wowie? They beat expectations. So
Mhm.
as long as that kind of supports and consumers still try to at least survive with the current rates that we're facing,
Mhm.
um, until something breaks, I guess the stock market is indicating otherwise. Nonetheless, it's been selling off. So That's one thing to keep an eye on. How far are we falling from as of this time? So retail sales. So just speaking of consumer appetite, we have now seen a slowdown. Retail sales fall for the first time this year, signaling bigger bite from inflation. So a slowdown. We are now at negative sales growth for last month. So this is not a good sign. If the trend persists, it just means that not just the consumers are dissatisfied, as reflected in the University of Michigan survey that we closely look at on a monthly basis. It's now reflecting in the books of big companies that are reporting their sales. So I guess Michael Burry, at one point, if you follow his Twitter page, he had indicated when Amazon came out with their earnings about a month ago that this is the first time, or not the first time, but this is the American consumers showing the weakness, and now it does definitely reflect on the latest retail sales report.
Mhm.
So cryptocurrency, not just a couple of episodes ago, me and Wowie already discussed the layoffs that we have observed in startups, but now
Mhm.
we're looking at some layoffs too in the crypto sector. BlockFi, they're reducing headcount by 20%. Coinbase, one of the largest. I think one of our episode I said that they might be the largest one, but I think it's Binance that's the largest, which is privately held. But Coinbase is reducing 18% of their workforce. Gemini, we're going to be cutting 10%. Crypto.com 5%. So, yep.
So the layoff continue on the tech sector, the layoffs.
Yes, and I actually found a website that we could jump on right now. It's intellizense.com. They publish this data freely. I think this is my only free trial right here. But
Mhm.
as of June 5th, so this is older. Excuse me. This has been 10 days old, but these are some of the companies that have announced layoffs. So we're not only stuck with the small and startup companies and cryptocurrencies, not only in the fringes of the market, but these are the big tech, not big tech, but big companies in the US. Tesla is laying off 10%. TomTom is laying off 500 employees. Coinbase, I guess, yeah.
Mhm.
BBC4. BBC4 is a media company, TV channels, 1,000 job cuts in the next few years. Uber, well, we have heard from Uber.
Mhm.
Facebook is also hiring. Freeze, Klarna, Swedish payment giant, laying off 700 employees. So AliExpress, which is owned by Alibaba, laying off 624. Carvana is laying off 2,500 employees. So, and the list goes on. Robinhood laying off 400.
Mhm.
Condé Nast. Is this serious number of employees laid off 90%? Are they shutting down
Wow.
like this?
Russia influence, Russia effect.
Okay. But 90%. Okay. They're terminating Condé Nast Russia. Okay. Gotcha. 90%. Wow. Bluebird Bio. This is a biotech company laying off 30% of their employees. Funko. Those little toys. 258 employees. Baidu laying off 15%. DD, the one that
3,000. Wow.
just got delisted. Peloton, 2,800. I think I skipped some.
Mhm.
J Sainsbury, it's like the Walmart there in Europe, lays off 2,000 employees. Peloton, I mean, this company was one hit wonder. It was a perfect COVID lockdown stock, but
Mhm.
it's been
Not right now. Yeah.
for sure.
Post COVID, not performing post COVID.
Yeah, I think they lost more than 90% of their stock. Even Nestle, one of the largest globally
Yeah, and
well-known brands, laying off 474.
Tesco is like the Walmart of in UK, that's a lot of employees, like 1,600 employees being laid off.
Yeah, Unilever letting go of 1,500 people. Management roles, reorganization globally. This was announced January. So we just have to make sure we track this. So I'm gonna put a star here. Maybe we could look back at it in a few months or a few weeks from now. So
Mhm.
obviously the S&P 500 is a bear market. So
And companies are laying off workers to improve their balance sheets.
yes, they're shoring up their balance sheets, making sure that they can pay off their debt. Because right now, interest rates are nowhere to go but up, 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 up. Right now, the mortgage rate for 30 years is actually at 6.04%, whereas a couple days ago we were at high as 6.28%. We haven't seen that high level of mortgage rates since 2008. So that kind of spooked everybody.
Mhm.
So we haven't done this for a while, but now we're looking at some cryptocurrency as well. So
Mhm.
Bitcoin, it's down 31% within the past 7 days. It's down 8.5% in the past 24 hours alone. It's down less than 21,000. If I'm not mistaken, Huawei, I think Michael Saylor of MicroStrategy has over 4 billion or 3 billion invested in Bitcoin to begin with, and his margin call is at $21,000.
Oh my.
Right now, before today, I think MicroStrategy is down 1 billion something dollars on its Bitcoin investments. So if they're gonna get a margin call for those who are not aware, it's a terrible well, it's a terrible option that would happen if you have bought stocks against margin. So what Michael Saylor did is he bought a lot of Bitcoins and he didn't have enough cash to fund everything. Of course, he bought some outright with cash, but some with margin. So with margin, it's like borrowing against your assets. As long as the stock or the asset, in this case, Bitcoin, doesn't fall within a certain price limit. If it falls more than that, the bank or the counterparty who took the risk, who forward you the money in order for you to buy that asset, has the right to call you to show up for the assets. And if you don't have the cash for the assets, that counterparty will sell those assets outright, and they have the right to do so, leaving you at a permanent loss. So MicroStrategy could be facing a margin call any moment now, and it could further end up in a sell-off in cryptocurrency. So Bitcoin now at 20,600. That's incredible. Whereas last year, right, Huawei, we were looking at 67,000, 69,000 even for this
Yeah, like around 68,000, and now it's down to like 20.
20,000. That's
Mhm.
crazy.
I
If it,
don't know if it broke that floor to 19. I haven't checked,
uh,
but it's likely it's gonna go lower.
yeah,
So,
people are
so I'm a crypto investor, but mainly most of my investment is on Bitcoin and Ethereum.
Mhm.
So it's not unusual for this cryptocurrency to go down like this. But
Right,
this is the deepest I've seen in a while.
right. 20,611 as we speak. Ethereum as well is closing more into the 1,000 range, $1,000 mark. Ethereum is right now is 1,096 and 43 cents. So not so long ago, it was around 3,000, I think, right? Or 2,500 per Ethereum. And I would like to look at Dogecoin. Dogecoin is down to 5 cents a piece, whereas some time ago it was around 30 cents. So everything's been selling off for sure. Oh, and not to mention, like, we're speaking it with round numbers. So Bitcoin now is close to 20,000. Ethereum is close to 1,000. Dow Jones ended the market today less than 30,000. Nasdaq is down at I think 11,000, right?
Yes.
So we're closing in those round numbers. Nothing's specific, but it could mark as a support or resistance come what may. But those are good indicators, just to see how far we have fallen since the start of the year. So there's a Seeking Alpha article that was published yesterday that caught my attention. It said investors have made over 100% since the start of the year, shorting Coinbase and other crypto stocks. So I'm not the one who shorts the market or any stock in particular, but for those who are like finding diversification through shorting, and if you have profited so far this year, kudos to you. It's very hard to short any stock going into this type of environment, not unless of course if you have Michael Burry's mentality, that can definitely like withstand any criticism and just stick with your investment analysis. I'm pretty sure he's been 1 year early in all of these predictions. Even during the subprime crisis, he was shorting the market in 2006, right? And then he actually got a margin call at one point. Investors started suing him, but he came out to be true. All of his predictions came out. So it's quite scary right now because he's still been tweeting back in May that we haven't seen any much of a let up yet in the sell-off. So and there's much more worse things that could happen, according to him, back in May. And that's when he started shorting Apple too. So that's one thing to look out for. Because if you're an investor, or if you are not an active investor and you have 401ks, the number one stock in your portfolio, if you only buy mutual funds and ETFs, is Apple. And that's the one that he's shorting. So he's going big. Right now, he's probably generated a lot of profits already, but I don't think he had closed that position. More blood in the water, I think. Right, Wawi?
Yeah, it's a fragile situation for the market. Something disastrous happen uh, um, right now, things will go more sour. So
Mm-hmm.
so if you're a long-term investor, it's just like, Michael Berry, if he's shorting, he's predicting that things will go down, and some other people are also predicting it will go up.
Right. There's always a counterparty. Um,
hmm
that's what makes the market. And right now we just looked at the liquidity. So right now it's more fear
hmm
that's hovering over us. So we'll see how
Yeah,
it.
so that's the liquidity. That's what you really need to look at. How much liquidity is out there, and how much trading is going on. If it's hard for you to buy or sell, then this market is gonna go you
Mm,
know go nowhere.
right. So this is a Empire State Manufacturing Survey that just came out. So we're just gonna hover onto it and look at some look at some parts of their report. So they said that activity levels off. After declining last month, manufacturing activity held steady
hmm
in its June report. Employment grows solid, according to it. Optimism remains subdued. Optimism about future conditions was subdued for a third consecutive month, according to this report. So if we're going to look at its chart, business conditions have slowed down for sure. New orders have recovered somewhat. Shipments have bounced. Unfilled orders have declined. Delivery time have increased because of the logistics. Inventory has been climbing up. It's up 17%. The index, so not up, sorry about that, but the index is at 17.1% compared to 7.9. So definitely our inventories are climbing up. So prices paid definitely reflects the overall inflation that we're currently having. Here we go. Forward-looking indicators, expectations 6 months ahead. So business conditions have been slowly on a downtrend since
Mhm.
even late last year until now. So it's declining. New orders have slowed down as well. Shipments have slowed down. Unfilled orders are now in the lowest since 2016 at least.
That's
The
good.
delivery time has been going down. Inventories slowly climbing up. So I guess it just reflects that there are some parts of the market that have been like running slow, and definitely
Mhm.
inventories are piling up. Inflation is roaring hot.
Mhm.
So now we're gonna look at least a couple of roll the clip segments, things that we haven't had in the past couple of episodes, but these are short ones, but good ones. These are the best Wall Street has to offer, and we're gonna go listen to him right now. First one would be Michael Wilson. He's the chief U.S. strategist of Morgan Stanley. Has always been bearish. Has been calling for a sell-off since November of last year. Most people didn't believe him at that point in time, even until December. But looks like all of his theses have played into exactly as to what it is right now. So let's roll the clip.
Let's bring in Mike Wilson. He is Morgan Stanley's chief equity strategist, has been bearish all year, has been right on the markets. Mike, what did you hear today from the Fed that might dictate the next move for stocks?
Yeah, I think Mike did a nice job of summarizing. I mean, we sold off hard into this meeting, both bonds and stocks. I mean, in a way like we've rarely seen. I mean, 10% move in stocks in 3 days, and the bond market move was even worse. So the market was very prepared. They even leaked the story to us. So there's relief here. We're up 2.5% after being down 10. It doesn't really change our intermediate term view, unfortunately. I mean, I don't think this is going to solve the inflation problem overnight. And it also raises the risk of a recession because you're bringing forward rate hikes even faster. And I don't think it's going to help the bond market. So in other words, you're in this vice still that we've been talking about all year. The reason we've been bearish is because the Fed is hiking into a slowdown, and they don't really have a lot of options. They have to continue to do that.
So what would it take, Mike, to make you feel better, to make you feel that it was priced in, the weakness that we are going to get here in the economy, even potential recession?
Yeah, so we've been very explicit about this 3,400 level, maybe 3,500, and that's really based on our valuation work that assumes no recession, but some degradation in earnings from the margin pressure, and then the appropriate multiple. The one thing we've gotten wrong this year was that rates went up even faster than we expected. And the surprising thing to us, Sarah, is that as rates have gone up, multiples have come down, but the equity risk premium component of the PE has actually lower today than it was at year end, even though the risks of growth are higher. So we just think the multiple is still too low for us to get excited, because remember, you have the upside, and if earnings are going to be coming down over the next 2 or 3 quarters, you're not going to get bailed out by that. So 3,500 on a price basis, we get more bullish. And then we get more bullish if we felt like we had visibility on the soft landing scenario. Chair said the same thing. We don't know if they're going to be able to do this, but if we had more, evidence that was happening, then that clearly would get us more bullish.
I think the path is certainly narrower after the triple rate hike today. You're talking broad market. You're talking about the S&P, Mike. What about the NASDAQ, though, which has seen a lot more damage? And you've got the NASDAQ 100 off more than 30% from its recent highs. Has that done more work beyond just the multiple correction as far as pricing in and earnings slowdown?
It really hasn't, Sarah, unfortunately. We haven't seen the earnings revisions yet to the degree we need to in either index. At the index level, I mean, it's kind of surprising to us, quite frankly, that the forward 12-month estimates for both the NASDAQ 100 and the S&P 500 are still going up. So there's work to do on both indices. The NASDAQ is down more simply because it was more extended on valuation at the beginning of this year. And, as we've been saying all year, we think that the technology sector itself has more risk of payback and demand than, say, the average company within the S&P, which has things like energy materials that are actually benefiting from the inflation.
Did you say
Bring in Mike.
he's looking at 3,500, right?
Oh, I didn't catch that. Yeah.
And in one of his report, I saw that he's looking more comfortable buying into the market. The market, excuse me, reaches at least S&P 500 reaches at least 3,500. So that's a little bit ways off from today's close for sure. Today, where did we close? I think 37. Oh my, we are 366 right now. What?
Okay, so getting closer to his 3,500 floor. So
Yeah,
he thinks that's the bottom.
if that's gonna happen, we're gonna be down further 4 or 5% from where we are right now. I mean, what's a little bit more pain to go, Wowie? Come on. We've done so
Yeah, but
far.
I don't know. I just don't know where the bottom is gonna be.
Yeah.
But it could be 3,500. But I keep buying. I keep buying on the downtrend.
Yeah.
It's rather silly of me, but I'd rather buy when it's going down than when it's going up. Well, sometimes I buy with momentum, but
Right.
uh,
If I'm not
it's better when it's going down.
yes, that's true. Discounted stocks.
Yes, sir.
One thing's for sure. I remember Michael Burry again because I was running through his tweets. He said at one point that he's looking at somewhere around 1,800 for the S&P 500. So 1,800 from here, that's quite severe. That's like
Yeah, that's a long drop.
Great
Woo,
Recession.
That's like a cliff.
Yep. So that's quite target point right there. If you
So
think
historically, what would equal that? What would equal
he based it from what happened back in the housing crisis, 2007,
2000, 2007, 2008?
and also
Well,
or during the tech bust. So that's what happened back then. So that's quite a huge drop from here, even though we were already suffering quite big in our portfolio. So all right, so on to our next clip. Okay,
my favorite, Mr.
Tom,
Tom Lee.
Tom Lee's back. He's from Fundstrat. He's a managing partner. This interview also happened yesterday, like the one that we just heard. So let's roll the clip.
Today, and how will the market react? I think markets have already priced in 75 if you look at interest rate futures. So I would say that makes a lot of sense because the Fed doesn't necessarily want to surprise markets. And I think that I'd agree with those who say that a move like today is probably better for risk assets, only because it really narrows the perception about how far the Fed is behind. A simple way to look at it is the spread between the 2-year and Fed funds, which Jeff Gunlock has mentioned many times. And it's at the highest level since May 94 today. But after the hike, this brings it down to levels that were actually lower than we were around April of this year. So I think in some ways, investors could actually start to feel better that the Fed isn't as behind, fewer sort of upside surprises. And of course, the data has to start cooperating going forward.
But they're going to be really aggressive going forward. Don't you agree with that? You saw Fed funds futures, what Leisman was talking about, where rates could really be going. The market's just going to be just fine in that scenario. I think people have a hard time believing that it is.
Yeah, there's I would say that nobody can say the macros is super clear right now. I think it's been helpful to see some of the slowing and the job cuts, because that just shows the current hikes and the current tight financial conditions are slowing the economy. And I think, of course, the unknown is what happens with gasoline, because that is really driving people's perceptions about CPI. But on the flip side, I'd agree with what Kevin and Jim have been saying. There's a real test happening to corporate America here. In the pandemic, people expected earnings to collapse, but companies slashed costs and managed through that well. And I think that really earned them a view that they're kind of much more durable than people expected. And now I think investors are also assuming that companies are going to get massacred in this current environment. But if they're going to navigate through this better than expected and earnings hold up better, then we're talking about a situation where investors are risk off. The Fed isn't necessarily going to shock markets with further surprises. So even if rates, if the Fed hikes from here, a lot of that's already priced into future interest rates. So there's fewer surprises to discount rate and what you think risk premium should do. And so I think stocks could do a lot better.
John and Jerry, and I want your counterpoint, I suppose, because you're extremely negative, it sounds to me. Again,
So I think Tom Lee still sticks with his call. At least
Mhm.
somehow market
Yes.
would still be positive.
Yeah, he's still bullish forecast for the economy, but that was yesterday, and he said it was priced in, but I think the market is still pricing it in as we saw today.
True, markets started selling off. Kroger came out with a report yesterday, which we could take a look at, see how they did. And Adobe also came out with a report just now.
Oh,
Adobe actually beat expectations, but
really?
they're
That's
selling off. Yeah, they're still down though. They're down 5%, I think, after March.
Mhm,
The market is very unforgiving right now.
mhm. Yeah, everyone's well, not everyone, but it's more of a risk off, right? Risk off environment right now. That's
Yeah,
the tone.
risk off sentiment for sure.
Mhm.
But yeah, we're gonna take a look at their earnings. Probably come on our next episode. Well, at this point in time, Wowie, do you have any quote for the week for our listeners?
No, just hang on tight.
Hang on tight and make sure you have emergency funds, right, Wowie?
Yes, a 6-month emergency fund is good to have.
Yes. Well, thank you for your time this afternoon for joining us in this episode, Mark, you and Wowie show. Appreciate your time today, Wowie. And
Appreciate your time, Mark. Hope you get well soon.
thank you, and hopefully everybody stays healthy. And for now, that's gonna do it. This is Mark Hughes signing out.
Wawi Santos signing out.